And private equity tends to target, I don't want to say what you'd call boring businesses, but the ones that are have a bit less flair to them, or more of a tech angle.
They're less sexy than the tech ones.
How do we improve the operations of this business? How do we grow it? How do we scale it? And we'll make our return by growing, not by relying on financial engineering.
You need to go through management consulting or investment banking first, get a bit of training, understand both sides, the sell, the buy, and then you can make your way into private equity.
There's a tremendous amount of opportunity at the sovereign side. At the smaller side, I think there's actually even more opportunity because the market's just not well covered today, but it's still developing. At the end of the day, you never want to be in the position where you are competing directly with a local government. I am personally extraordinarily confident in the trajectory in this country and in the wider region.
Hello, everyone, and welcome back to a new episode of For Those Made to Do. Today, we're dedicating this episode to those made to do private equity. And it's a really, really exciting one for us because we've been thinking about it for a while and we've been hearing a lot of our students talk about wanting to start a career in finance. They usually talk about wanting to go into investment banking, venture capital, or private equity. And out of these three, we think PE is one of the most exciting, but also one of the most challenging career paths to get into. Just looking at some numbers, it looks like the hedge funds in DIFC, which is the financial district for Dubai, have grown by 72% just this year alone in the first half of 2025. So it's a great time for us to be looking at this. And luckily for us, we have an incredible guest in the room today. He has already achieved a lot of success in this space, and he's here today to share his career journey with us. So, Adam, we're so excited to welcome you to the studio. Thank you so much for giving us your time today. Just to give everyone a bit of background on you, Adam John Siracusa is the managing partner at Oryx Legacy, which is a search fund focused on acquiring a single standout UAE-based company. So you're looking for that one winning company that you're going to make your big bet on. Adam brings over 10 years of experience in investing and also advising across the Middle East, Africa, and the US. His career spans roles at BCG, Cross Boundary, Monitor Deloitte, and most recently Safanad, which is a global investment holding company where he helped both design the firm's GCC private equity strategy and also work closely with the portfolio companies that were expanding in this region. So he's got a lot to share with us today. We're super lucky to have him. And first of all, how are you doing? How's your day been so far?
Doing well so far. We're actually working on a transaction right now. So
exciting.
Yeah, no, the morning was spent going through a lot of details around that.
Oh gosh, so we stole you for a couple of hours and then we will return you intact so you can continue the good work.
So we thought we'd start off with a little bit of an icebreaker because we are going to get into the details of private equity. And we just thought maybe you could start off by telling us what is the best deal that you've worked on in your career? What would you consider to be the deal that has given you the best career highlight so far?
I mean, I'd be remiss to say it's the one I'm working on right now.
Ah, nice.
Because I can't say a ton about it, but what we're really excited about is it's a chance to build a platform in the Gulf, especially, and in the UAE that eventually goes regionally. And we're in a market that in some ways is very much ahead of the curve, but in other ways is a lot of the waves and trends that you've seen in the West, whether it's the UK or US or Europe, happened probably 10, 15 years ago.
Yeah.
And I love the fact that we can look at this opportunity here, say, we can clearly map out where this industry is going because we've got a ton of examples of exactly that happening elsewhere in the world. We can chart the growth journey pretty clearly, and we know how we'd create value. And because it's unlike some deals where you're betting on tech innovation or something else that you're speculative in a lot of ways. In this case, we know exactly what we need to do. We know exactly what good looks like, what success looks like, and the deal writes its own story in that sense. So probably this one.
Okay.
But fingers crossed, we'll close sometime early next year.
Amazing.
That's exciting for your first venture on your own to have something like this. I think it'll be exciting to kind of watch that unfold from our side. So our audience is people who are studying in a period of transformation, looking to kind of switch skills from one place to the other. So with that in mind, if you had to describe the UAE's private equity market today in one sentence to a global investor, what would it be? And what would be the blind spot outsiders often miss as well?
I'd call it developing or nascent. Now, what people I think often miss, people will hear about the sovereign wealth funds, the amount of liquidity, amount of capital in this market, which is all very much there and true. But what they'll often miss is that the market in the UAE is a few different parts. On the one hand, you have the sovereign wealth funds. This is your ADIA, Mubadala, and ADQ in Abu Dhabi, your PIF in Saudi, QA in Qatar, etc. Now, those are all $100 or $200 billion plus entities. They have a seat at practically any table as an investor, and they invest both globally and locally. But those guys can only do deals that are really $100 billion plus. And because most of them the basic math is that a sovereign wealth fund, an investor of that size, needs to take 10% at minimum of a transaction. And the minimum they can deploy is $100 million. Otherwise, it's just not worth your time. It's not worth their time and effort for the amount of money they have to move. They have a seat at any table, and they invest globally. And these days, because of the wall of the need for capital, for fresh capital in Western markets especially, everyone is knocking on their door. But that's one side. And they look globally. The other side locally is the hedge fund ecosystem, especially, which has emerged in a mix of Dubai and Abu Dhabi very recently. And I mean, by recently, in the past 3 years or so. Mm-hmm. And that's benefiting primarily from just time zone convenience of we're in the middle between Asia and Europe. So you can still cover both markets, without being awake at absurd hours, tax benefits, lifestyle, etc. But then you come to the PE landscape locally. And that is very nascent. And that's because the UAE especially, and most of the Gulf markets in reality, are not huge domestic markets. The way I put it to a lot of people is the UAE is kind of like the Greater London area. Yeah. In terms of its size, drive time, etc. They're both about 12 million people. Takes about 2 hours to drive across, and they're both, give or take, $600 billion economies. When you put it in that context, you're always going to struggle to build a large domestic investment landscape. Now, the entire Gulf gets more interesting because at that point, you're talking a market the size of Italy. That is more interesting. But each of these markets, the challenges, each of them are different, and the dynamics in Saudi are different from the UAE, which are all different from Qatar, Bahrain, etc. Yeah. So while you've got the big sovereigns that everyone's heard of, you've got the hedge funds. At the private equity side, my guess is there are, give or take, about 10 private equity managers that do local transactions in the lower to middle market range. That are not the deals that involve the sovereign wealth funds and the like. I'm just going to do a disclaimer here then at this point, because I know very little about this industry, and so some of the questions I might ask you might be basic, but I think it's good to kind of probe a little bit. So I'm just going to disclaimer that. So in the context of 10, is that little or large? That's small. Small, very small. There are thousands. There are a few thousand firms in New York, for example. Got it. Okay. At least I've not seen. I think the last I saw, there are 20,000 private equity firms, give or take, globally. McKinsey and Bain both do pretty good studies on this. I just forget what their most recent ones have said, but that number feels about right. The biggest concentration of PE firms is going to be in New York and London. I was just doing a little bit of research on the history of it. And I think the US PE market is about 120 years old since the early 1900s. And here in the UAE, it's about 20 years old. So really a fraction of that. So yeah, I think if you look at it at scale, I think it's very much nascent, like you said. And it's pockets. It does depend what you're doing in this market. If you wanted to play at allocating to your Blackstones, your KKRs of the world, at that scale, then you will see everything under the sun, especially these days when the markets, everyone's knocking on their door here. But at the and there's a tremendous amount of opportunity at the sovereign side. At the smaller side, I think there's actually even more opportunity because the market's just not well covered today, but it's still developing. And
got it.
It'll take time.
We've kind of set the landscape a little bit. And how would you explain the nuances between private equity, VC, investment banking, in a way that a graduate could use it to decide their own path?
The way I'd frame it is, first I'll put investment banking to a side. Investment banking is much like consulting, predominantly an advisory role.
Yeah.
It is not you're not generally allocating capital or making decisions. And usually the way to determine is that's the sell side. An investment banker is hired by either a business owner or a company's management themselves to execute some kind of capital activity, whether it's raising debt or raising equity or managing a sales process. Then you've got the buy side, which is hedge funds, family offices, private equity, and they all in essence play a different part of the equity story. So hedge funds will invest in primarily liquid stocks or liquid instruments, whether it's bonds or currencies or you name it. That's one side of the coin, and they will trade on public exchanges, public markets primarily. Private equity is private investments into companies, into the equity stack of companies. Those are non-listed companies. Sometimes a private equity firm will buy a listed company and take it private, or they will buy a private company that's already private and keep growing it, and then look at listing it publicly and exiting it. But they're operate as private entities. Mm-hmm. And private equity tends to target, I don't want to say what you'd call boring businesses, but the ones that are a bit have a bit less flair to them, or more of a tech angle.
They're less sexy than the tech ones. Right?
Less sexy than the tech ones, exactly. Yeah. Now this divide does get, at certain sizes, it starts to merge around, get messy, but none of these are necessarily clean divides, to be very clear. But private equity tends to do that, and private equity will operate at sizes as little as what I do, which is the max $20 million transaction, all the way up to the EA transaction that got announced yesterday, where PIF is with a few partners is buying EA for $55 billion. Mm-hmm. So private equity's got a pretty wide remit. You then have growth equity, which tends to be more later stage technology companies. And it's something I think a lot of people are interested in when they think of, a tech company that's got momentum, is growing, but just needs a bit more capital to keep growing. And then at the smaller side, you have venture capital, which is mostly targets tech-driven businesses. Depending on what stage the venture investor is, they could be investing at the stage where you're literally just taking a bet on one or two people, all the way up to, okay, they've got product market fit, they've got some employees, they're a decent size, but there's a range in the VC space, but VC tends to focus on startups that are tech driven.
For the growth capital, what would you say is the average deal size? It'll
range. It can be, VC tends to operate in a, angel round, seed round, then series A, B, C, D, and I think I saw one company has like a series W even or something. But you'll keep raising and that's kind of the VC playbook. Now, I've heard of very few that go beyond a series D, but that tends to be the VC playbook. Right. Growth equity would tend to step in when you get to the, call it later letters, where you're looking at C, Ds or beyond. That's when you start having growth equity kick in. It's often in the, call it the few years before the company might be in a position to go public.
If we take a quick step back, just to understand what the day-to-day job looks like. And let's take you as an example. So you just said that you're working on the biggest deal of your career, which you're super excited about, and we're stilling you for a couple of hours. But at your level, so you've got 12 or 15 years of experience in the space. Yeah. What does an average day look like for you in terms of where you put your focus and the kind of work you're doing right now?
It varies depending on the type of place you are. So for me, I'm on my own. So and as a result, I need to do practically everything. It's all the way from, meeting with sellers, meeting with government, all the networking side, all the way down to building the pitch decks, the teaser decks, the investment memos, running the diligence process, working on the model, etc.
Yeah.
It's at the end of the day, I'm one person, so I have to do all of it in one form or another. Now I can outsource parts of it, which I'm doing, but you can only go so far.
Kind of an entrepreneur.
Yeah.
Because that's what it is, right? Yeah.
Oh, 100%.
Yeah.
If you're in a major institution, a sovereign wealth fund or a large private equity firm, the levels are pretty clear. As an analyst or associate, i.e. kind of in that 2 to 6 years out of undergrad, you're working more on the model and you're, working on the materials. As you get to the vice president and director level, you're more focused on sitting on the company board and working with management on strategy and overseeing the model and materials build. And as you get even more senior, you're really you're the one doing client engagement, networking, etc. And you're managing this entire infrastructure underneath you. I would say private equity operates similar to consulting, law, and investment banking. All of these are what I'd call apprenticeship-based models at the end of the day, and they're pyramid structures. So you've got a ton of people at the junior level, and then fewer and fewer as you rise. And those that are more and more senior are, a core part of their job is mentoring and supporting the people in the level below them who do that all the way down the food chain.
We have an episode, it's a few episodes back, we were talking about marketing with Shire, and he's an ex-P&G Procter & Gamble person. And as he was thinking about his beginning in this space, he really talked about P&G as being a marketing school. And the reason he said that is because he saw his job, at least in those first few years, as going to school and learning how branding and marketing and market research, consumer insights and analysis, etc. He kind of had to learn everything from scratch. So it sounds like consulting, investment banking, PE are also kind of working in that same space where each company is schooling essentially their analysts or just preparing them to then rise through the ranks and then do the more high-stake work later on.
100%. That's exactly how the industry works. The added nuance, which I think relates to a lot of students and what private equity. So in private equity and in hedge funds as well, but in general, a lot of investment-driven companies, they're usually not huge organizations. They don't have they don't hire hundreds of people where they don't have a big training department and all that infrastructure to really develop people, not in the same way. So the most common route into private equity for a lot of people is to do 2 to 3 years as an investment banker.
Yeah.
Because the banks, exactly your point, they do have that infrastructure, or they join a consulting firm, which, they'll host multinational training camps for all their new hires. They have very well established, development frameworks, pathways, what you need to go to, what skills you need to learn. They map it out extraordinarily well. And exactly that, they're a boot camp.
Yeah.
They definitely take a few years off your life, probably by the end of it in terms of how hard they work you. But I think there's no real substitute in many cases for just grinding it out in some of that and really getting into the weeds of how do you actually do this role. And that then opens up a lot of other things because, anyone on the buy side of these will understand, okay, you went through a few years at Goldman or JP Morgan or pick your bank. All right, we know what they taught you. We know what you learned, and those are all relevant skills.
And it's also usually the people that move, whoever makes the jump from investment banking into PE, for example, then a couple of years later, when they need to grow their team, they'll go back to the analysts they had and nurtured and taught themselves at Goldman Sachs. I have a friend who went to Goldman Sachs from business school, and then 3 years later, he went into KKR. And he already knew, and that was already prearranged from his school. He knew exactly what he was going to do. He just went and did it because that is the route. And I think that is one message that we're passing on to our students and also listeners today, that private equity, the reason we're talking about it today is because there is no direct jump, or there's a very, very, very rare direct jump straight from business school. You need to go through management consulting or investment banking first, get a bit of training, understand both sides, the sell, the buy, and then you can make your way into private equity. And that's kind of how, that's the long-term commitment. Can we talk a little bit about the management side of private equity? So the operation side, right? So private equity is about buying a company and then making it better and then selling it later or taking it public. Who are the people who do the management side? So beyond the finance and the acquisition, what happens in terms of actually making a company thrive, and what's the route into that space?
It's interesting you hit on that point. That is, I'd say, one of the things that's changing most significantly in the private equity investing landscape today. The historical approach was a private equity firm goes, buys a company, borrows a ton of money to fund that acquisition, takes over the company, they sit on the board, they hire a CEO or keep the existing one if they like them, though usually they replace the CEO. They work with that CEO to replace the management team, and then they sit on the board and they wait to see what happens. And they rely on the fact that, in generally speaking, debt is cheaper than equity. And so there's a cost of capital arbitrage. They make their money off of that. And someone else does the development of the company. They just sit there and watch it and approve it. That was the historical approach. It worked very well when interest rates were rock bottom and money was, as a result, basically free. That has, I would say, started to break down quite substantially. With debt being more expensive these days, I mean, rates are, fine, they're dropping now, but they're still in the 4+ range for treasuries, which, add a bit on then whatever the spread is for whatever you're acquiring. Debt isn't cheap. And so you lose some of that arbitrage as a result. And what people are realizing is that to actually develop a company, you might need to be more operationally involved. There's more to it than just sitting on the board. And so a lot of firms, and you see it all across from big all the way to small, is, KKR is famous for, they have an in-house consulting team called, I think it's called Capstone. They might have renamed it since I last heard about people on it. But it's a value creation team. They go in and they look at their companies and they do basically what a McKinsey or BCG would do for the company, with the view of, we need to get very involved in operations. ADQ here also has a huge a sizable value creation team as well that's focused on the strategies they care about. So I think that's a big shift, is people are just getting more involved. Firms are also building out, proper advisory boards and, the operating groups to support their portfolio companies, which didn't used to happen before. Historically, they'd say, great, the analyst, director, partner that led the deal, you run the deal. Now, a lot of firms are saying, wait a second, a partner in that space might not know as much as, say, the former CEO of a competitor or someone who's on the market. Let's bring those people
in. Yeah.
So during the acquisition process, because I have a friend actually who's going through this process at the moment, and they're the MD of the tech firm that's being sold in essence. How often is it beneficial to have that person who's already in the seat to stay in the seat, or is it better to just get fresh blood? What's the thinking? What's the logic behind that? What do you tend to typically see?
It depends. I mean, it depends on the nature of the deal, but also it depends how the deal was structured, how the company was operating originally. If it was a family-owned business before, usually the MD is also a main shareholder and they're cashing that person out and that person's trying to exit.
Yeah.
If it's a listed company, it depends. It depends what the feeling is about the CEO's performance and the management team's performance. If the belief is, quite often is the team is great, they know exactly what they're doing, they just need capital to grow and we believe their investment plan, then fine, they'll often stay in place. If it's a situation of, no, this company was not well run, we see a lot more value in it, we need to modify the strategy, take it in a different direction, then that whole team might go.
Got it.
So it does depend. But the operational focus is a sizable shift, I would say, in the private markets landscape. All the way down to the deal I'm doing, I'm taking it over at the end of the day. And so we're saying the heart of this is it's operations. It's the value we're creating is not going to be, a cost of capital arbitrage. While that might happen and that's great, the real value is how do we improve the operations of this business? How do we grow it? How do we scale it? And we'll make our return by growing, not by relying on financial engineering.
So you mentioned before that there are a few key players in this region. So I just want to circle back to it for a moment. So you mentioned sovereign funds, family offices, regional PE firms, and amongst these players, can you tell us a bit more about how power actually circulates and where a young associate can position themselves to be in the right place to learn the most and to kind of have some influence in the process?
They each exist in their own universe in many ways. So you have the sovereign wealth funds, the family offices, and the private equity firms, simplistically. The sovereign wealth funds are sovereign capital. They do big deals. They have the biggest analyst pools, generally speaking, as well, just because at the end of the day, there's no family office in the world. I mean, maybe the Waltons get close, but that manages, $200 billion plus. It's just too big. It's too much capital. And so the sovereigns are big. Family offices are a very complicated bucket to deal with because they tend to be quite small in terms of team and headcount size. So which I think goes to what is your typical family office. And a lot of them are organized very differently. Everyone's got their own structure, their own preference. I mean, some are hyper sophisticated and very well organized, others really not. So it does vary. But most family offices, in the region especially, I'd call, they were formed because a patriarch 30, 40 years ago, maybe 50 years ago at this point, call it usually the 60s, 70s, found a great business. It was fantastic timing. They built that business. They, oftentimes in the region, they had an agency contract, which has been very common in the Gulf. And they built that business over 50 years. Think your, Majid Al Futtaim, who owned the malls, or the Al Futtaim Group, or Al Ghurair, or kind of in general, a lot of your big family names in the UAE, but in really the entire Gulf. They all have a similar story. Now, what differs is how do they operate now? I mean, family offices will range from being totally institutional, where a non-family member runs it. They've got a team. They have a very clear asset allocation strategy. They know what they do. All the way in the other side, it's one that's still run by the person who made a lot of the money, and they decide on a whim what they want to do, and that's that. So family offices are hard to pin down, but they do span the gamut. But I think the unifying theme is they're often not very big. Small teams, make decisions. If you found a family office that had more than 10, I would say, investment professionals, I would say that's unusually large and rare. Then you go to the private equity firms, which again, there's just not very many here. Now, they will often raise money from a lot of the family offices. So those two, they do work together. And in fact, a lot will also co-invest together.
Yeah.
So, if there's a transaction, they'll bring in, they'll say, look, we're doing this deal. The family office that's an investor with us, do you want to take a side pocket basically and invest in this, above what you would normally be exposed to because you believe in it? That happens all the time. And so, they often do work together. The private equity firms are probably because they're often raising money and it's not their money, their branding, their visibility is always a lot better. So you can actually, if you were trying to research private equity firms in the GCC, they're not hard to find who they are. They've got websites, public presence, you name it. Family offices, good luck. A lot of the biggest ones are deliberately and by design, very, very under the radar. So the private firms easier to break into. The family offices, much more network driven, much quieter. They hire when they need to hire, but they don't often hire systematically. Private equity firms, the bigger they are, the more and more they get themselves on here's the process for how we do things. Here are the stages. These are the levels. They institutionalize it, basically.
You would only know that if you were in the industry for a long time. Yeah. So thank you for giving us that golden nugget, I guess. Also, the city's changing. I think especially over the last 4 years since COVID, anyone who visits in recent times will see that there's a real estate boom going on. You can't look in any which direction without seeing some construction going on. Outside of real estate and energy, which other sectors do you see becoming the UAE's kind of unfair advantage in the private equity space? Is there something that's kind of emerging that we could discuss?
A lot of the bedrock sectors in this market are the ones that are getting increasingly popular. So, I mean, in the past couple of years, I mean, what have been some of the marquee deals you've seen, which I think kind of leads you into the direction of where do things sit? It was the GEMS transaction, which brought in Brookfield, which is one of the largest investment groups globally. I think they managed something like $700 billion. That was a huge deal. KKR, actually literally just earlier today, announced a deal with ADNOC on their pipelines. They also announced a data centers deal the other day.
Yeah.
There's always been a lot of activity around healthcare. In fact, the challenge now with healthcare is the valuations have gotten a bit out of whack because so many people are piling into the space. But the unifying theme is all of those are kind of what you'd call bedrock sectors in many ways. At the end of the day, kids need to go to school. You need medical care. You need, data centers are increasingly important. And those are...
So it just goes back to what you were saying earlier, like boring...
Yeah.
It's just things that people engage with on a day-to-day basis. It's like needs-based, isn't it, a little
exactly.
bit? Yeah.
Exactly. The only challenge in the Gulf sometimes is if you're a private investor, you have to be very attentive to what is government doing. Because at the end of the day, you never want to be in the position where you are competing directly with a local government. Their cost of capital is different. If they see something as strategic, they can eat a loss that a private investor could never eat because there are different reasons for them to do it. And so you always have to be very attentive to what is happening and what is the government's perspective. But on the other hand, if you are leaning into what the government's trying to encourage, returns can also be a lot higher because there is a lot of support, effort, whether it's affordable land or cheaper energy or you name it.
So is there like a partnership in essence that the government push from this perspective?
Exactly. A bit of both. It's, you don't want to compete with them, but it doesn't hurt to find areas that they care about and that they are trying to incentivize. And that varies, but it's in general, the unifying theme is it's a lot of the focus here is on the things that you need in any developed market.
And the blueprint's out there, right? When you see the 2030 vision, it's published, it's out there for everyone to see.
Which, and I will say is a change, but they've gotten, both the UAE and Saudi especially, have gotten very clear about what they are trying to encourage and it's very clear what they are investing in as well.
Yeah.
It is public information. It's not hard to find out what are they investing in. And so it is increasingly easy to say, okay, well, what do I need to lean into? For example, the big thing these days in Abu Dhabi is food security. They're great. It's, that's a highlight, and there's government support around helping build up in that space. Healthcare, post-COVID, there was a lot of effort around how do we build more resilient healthcare supply chains. That's always been a focus. I'll ignore the VC side because the VC side is more complicated, but there's, but I'd say in general, a lot of that stuff. I mean, I'm cautious on data centers because there's a lot of government interest in the space, but the problem you run into the other problem, which is while there's a lot of interest, the government's spending money on it. And so it's hard to say, I want to build a data center when you have, in the UAE, for example, it's the Abu Dhabi and Dubai is also through one of its entities is also investing in the space. And so hardcore data centers, all right, you're running into government or you're running into Salat and the government-linked entities. Maybe that you step back from, but in other areas where they're not spending money, but they're saying we'll make benefits available to you, you push harder on those spaces.
And throughout your career, you've worked in lots of different territories, namely kind of like Middle East and Africa. So do you see Dubai's private equity space as a springboard into these other regions? Obviously, Saudi's a big one, but also Africa. Is it on the radar?
100%, definitely. I think and granted, this might have been anecdotal, but the UAE was one of, if not the largest investor in sub-Saharan Africa this year. it's, or even North, actually might be all of Africa. I mean, after you factor in the Egypt transactions as well, there is a massive flow of capital from the UAE into Africa and South Asia as well. Both are very high priority markets for the country, but as well, a lot of, I'd say, African elites and business leaders in Africa, they spend a lot of time here.
Yeah.
As Europe gets harder to go into, London was always the traditional hub, or London or Paris if you're in Africa, London if you're in South Asia, were the traditional destinations. For various reasons, those are getting harder. And so a lot of that is being redirected here. So there is a lot happening. The flip side of that is it is mostly sovereign, it feels right now. There's not a lot of third-party managers doing much yet. But I think that is evolving. The challenge with private equity is when you're dealing with an operating business that you're going to get very involved in, you have to be on the ground. At the end of the day, if you're running you can't run let's say it's a food processing company or a medical manufacturer or a hospital. If it's in India, you need to be in India. If it's in Kenya, you need to be in Kenya. You can't run it from, an office tower in Dubai. And, Abraj was an example of this. Abraj did more damage to the private equity market here than when it blew up than anything else. But one thing they recognized and they were right about was you need to be on the ground. They had offices everywhere. And I think even the sovereigns in the UAE recognized that. They invest a lot in Europe and the US, and now they have offices in both those markets as well. The UAE will be a hub. I think a lot of the senior leaders will be here. A lot of the family office money will be here because, they like to base it here. It's safer. It's, it takes a Switzerland vibe onto it.
Yeah.
But at the same time, there will never be a substitute for, if you're running a business in a market, you need to be in that market.
Obviously, that's from here looking outwards. And then obviously, when we reflect on what's coming in, there's a lot of ultra high net worth individuals kind of gravitating to this region. So what kind of asset classes and deal sizes are suddenly on the table now that weren't there 5 years ago?
So call it the ultra high net worth rebasing here. A lot of those individuals are people that have an existing business elsewhere in the world already. So it's not, I would say, creating a new set of asset classes that didn't exist. What it's really doing more than anything is it's just deepening the talent base here. At the end of the day, when when you have business owners around, they start bringing in more lawyers, they bring in advisors, that ecosystem starts to follow and starts to deepen. And as that happens, and it takes a very long time. I mean, London's ecosystem was built over 100 plus years.
Exactly, yeah.
But as that ecosystem deepens, you see a greater range of ideas and activities happen. None of the asset classes that folks are engaging in, generally speaking, didn't exist here before this wave started. I mean, there's been VC here for 20, 30 years. There's been private equity's been here for a similar amount of time. It's existed. But I would say the depth, the quality of talent as a result, and the ecosystem to support it, that's what's getting a lot stronger. But a lot of these folks still run their businesses in a different market. I mean, a lot of people fly in and out from India all the time, or most of Africa. Dubai's a safe place, but you've still got the operating business in your home market.
And I think to that idea of talent with fresh ideas coming in, just a quick follow-up there. I'm wondering if there are any major differences that you're seeing in terms of how you execute a deal here in the Middle East, or particularly Dubai, Abu Dhabi, because there's a lot going on, versus other financial hubs like New York, London, and not just from a financial and legal perspective, but also strategy and culture. We talk a lot about the Middle East being different in many ways from Europe and the US and Asia. Are you seeing major differences here when you're looking at creating a deal?
Yeah, so any deal is, I'd say, very much, it's local, right? Mm-hmm. You're dealing with, and this is where I'd segment, if you're doing a global deal out of the UAE, you're going to be matching whatever the local culture is in the US or UK or wherever that transaction's actually happening, or Europe, wherever that deal's actually happening. If you're doing a deal in the UAE, though, for a UAE company, then you're grappling with what is the local UAE landscape look like. And there, I think you're spot on that every every market, every geography has its own local culture about how transactions are done.
Yeah.
And it relates to, I think one of the interesting things in the UAE, and one of the key differences is in most markets, you have a local culture. There is a American approach to doing things in the US or a British approach or you name it. And love it or hate it, and I think each one of these has a pro and con to them. They have there's a culture. The UAE is an interesting one because we're 90% expat here. And business owners aren't all Emirati by any stretch. A lot are Emirati, but there's a massive Indian business community here. Yeah. There's a very sizable Arab business community. There's a Western community. And one of the interesting nuances here is the transaction you're doing will depend on which community you're working with. Mm-hmm. And each will be different.
Have you navigated that then with all these different systems at play? How do you do it optimally?
It's about knowing who you're buying from. And at the end of the day, when you're depending who you're buying from, you can gauge that right away. It's if the individual's Emirati, okay, it's you run it like and you focus on what matters in a much more local context. With Emiratis or Gulf Arabs in general, it's much more. It's a very relationship driven culture, society, etc. And that's what you lean into. If you're doing with a Western audience, they can be a lot more transactional, and just that history, that especially in Anglo-Saxon, what is the deal? Well, the numbers, boom, boom, done. And so in some ways those are the two extremes, but I think that's you need to gauge. And sometimes, one of the challenges here is you need to be aware that in even access to transactions, in some cases, it's, certain communities will pretty much only sell within their community, and so you need to be aware of, and, a lot will get lost in translation if you're not comfortable dealing with, or if you don't understand that local culture. And it's when you're in a market, if you went to Saudi, for example, Saudi is very Saudi. It's, at the end of the day, and
they're proudly Saudi as well. So,
exactly.
Yeah.
But it's the business owners are predominantly Saudi.
Mm-hmm.
It's yes, there is an expat business owner population, but it's not very substantial compared to the Saudi ownership. So if you're in Saudi, you cater to what is Saudi culture, and that's what you're indexing against. In the UAE, and so it's either you can match to it and work with it or not.
Yeah.
But the UAE, you do need to be able to balance what are the different cultures at play, and therefore which one do you have to understand? And to be honest, nobody on the planet can manage every single one of these cultures. It's too difficult. Everyone's got their own personality, a set of mannerisms, a way of speaking, way of operating that will work in some and will not work in others. And it's, I think, something just you have to keep top of mind.
So I think that's something really important for young professionals to know as well, right? So they need to understand the full landscape as they venture into their careers. Now, on the flip side, when people look to hire in this region, when it comes to those capabilities that people are looking for, specifically you. So if you were to hire right now, would you be looking more for that hardcore data analytics side? Do you want more the research side in someone? Or would you be looking for their strategic and I guess people skills where they're able to work and understand culture and understand how to get into the rooms where it's quite difficult to get into? If you were to pick one of these three.
It depends. In my current setup, it's because it's predominantly me. I cover call it that more senior networking, that side of the coin. And so what I'd be looking for personally would be someone that's hungry, eager to learn, and can cover some of the more, I'd say, desktop-driven stuff that is, frankly, quite, is you need to grind it out in some ways. And for me, that skill set is also extremely useful, but I think honestly, it depends on the stage of business you're in and what anyone has or is trying to do, because any business will oftentimes need. Let me flip it slightly differently. There is a spectrum of jobs to be done in any investing role. It is everything from senior management, capital raising, transaction diligence, legal, all the way down to the model and the pitch deck. All of these jobs exist. And the question is just what does the person running that organization need at that point in time? But everyone needs all of it. And therefore, what do they choose to outsource versus do in-house, and how do they see that mix?
And if we're thinking a bit about how AI has come in and taken some of that research, analytical kind of part of the work away, and it's able to do some of it, maybe not to a perfect level, but some of it can be done. When you're looking into the future, so private equity in 5 to 10 years' time, which one of these three skills do you think is going to be the most valuable that people need to start kind of nurturing today? Because there is a tech revolution happening out there.
So it's funny. I've had this conversation a number of times with friends. I think one thing that's really interesting that you're watching happen, which is it's a tough one to think about, is what are AI tools likely going to be best at doing? Mm-hmm. It's taking on the rote, almost mechanical tasks that are very time intensive and therefore labor intensive, but actually don't massively deviate from situation to situation. And by this, I mean the obvious one is financial modeling. It is, you look at your typical financial model and I go, while every model is bespoke, I don't actually think that is a space that is comparatively difficult to basically completely hand over to an AI tool at some point in the next few years. Mm-hmm. It's, at the end of the day, a 3-statement model is a 3-statement model. Everyone knows what goes into those. Everyone, you have some modifications, but fundamentally a model is a model. And I think that applies to, now the trick for that, the problem with that is, and I think that there are a lot of other junior roles as well that are similarly running into this pressure. The challenge is you can't succeed at a more senior level without knowing exactly what's driving that
Correct.
Model. Like you can't make an informed decision on an investment or a deck if you don't understand exactly why things are moving the way they're moving, what goes into building one of these things. But at the same time, it's also the easiest to completely take the junior analyst out of. And if you do, what does that mean for the pyramid going forward?
Yeah.
And it's a hard one to answer, to be honest, but it's,
because a lot of companies, especially the consulting ones, they're aggressively moving in this direction. Yeah. So the value add there, the context there is going to be missing. There will be a gap. So it's like, how do you plug that in then in the long term when you see the after effects of just removing all the groundwork from a whole industry
and especially overnight. And consulting is doing that right now. They're cutting graduate schemes left, right, and center. But I think what happens is private equity, as we discussed today, actually relies quite heavily on the school of management consulting and investment banking. And if the nursery doesn't produce that analyst anymore, then I think these two industries or these three industries are going to be at a huge shortage of valuable talent in the future. So I think that's a pipeline that needs to exist in the future. Even if it changes, I think learning has to change in the era of AI. No one can teach, even us as a school. We're using AI, we're encouraging our students to do it as well. But we talk about the ethical use of AI, the critical use of AI, where it's supporting you, it's not replacing your task. And so I think there really needs to be a conversation around how do we then use AI to train the incoming generations of junior analysts and then the managers and the future VPs and directors.
Yeah, and I think the hope is that these tools eventually allow people to focus on higher order, deeper thinking tasks that are harder to outsource but that require, human thought. That's the hope. I think the jury's still out as to how this will exactly shake out. At the same time, I mean, I think everyone's struggled with an AI tool at this point at some point and said, oh, this thing is hallucinating and is, making a mess of what I actually wanted to do. So the jury's still out, I would say, but my view in general is I worry, or I think most about what it'll do to those rote tasks that are boring, time intensive, easy to theoretically turn over to a tool, but were the area where you actually learned a lot and you built mastery around, okay, this moves, I know exactly what's causing that, and and that's valuable.
Our last episode was on Gen Z, and this is what we discussed, that those foundational roles create the mastery. The mastery then is able to allow that space for critical thinking, because without one, you can't really do the other, because you're not going to understand what came before. But I guess we'll have to observe how this plays out. Perhaps there's a business opportunity there somewhere as well on teaching private equity with AI, and there's a school for that too. So let's see.
Someone will do something around that, I'm sure.
And then as we draw the conversation to a close, we want to kind of bring it back to this kind of career-related question. So if you were advising a graduate today, would you tell them that the private equity in Dubai is a 5-year career accelerator or a place to build a 20-year career? Bring all these themes together.
I am personally extraordinarily confident in the trajectory in this country and in the wider region. I'm betting my career on it, my money on it, etc. So fundamentally, I think there's a tremendous amount of opportunity here. I think there's a lot that's frankly going in, and the UAE in general and the region writ large, I would say, outside of some political issues outside that are, call it, imposed on the region, has had a fantastic 3-4 years.
Yeah.
And absent a external shock, the trajectory and the direction of travel is very positive. So I'm personally very comfortable saying investing and building this region is a 20-year bet, not a 5-year bet. And I'm very comfortable with the idea of doing it here.
Yeah, fantastic. I love the optimism. Yeah. I think just to finish off, I also feel like when I arrived here, I felt very transient. I wasn't sure, okay, how long I'm going to stay here, this kind of thing. But I have to say over the last year specifically, I really see the vision, the long-term vision, and what longer-term routes would look like. And I think it's translating across different industries as well, not just of a person wanting to be here, but also the infrastructure around it. Like, you can see longevity now.
Yeah, and credit too. It's things like, Saudi's Vision 2030 actually is defining, like, this is what we're trying to do. And all these countries will make tons of mistakes. That's natural, that's normal. It's actually to be encouraged, because if you're not making a mistake, you're not trying. And so it's, but the direction of travel is clear. In the UAE, it's, things like the golden visa system or, that's actually, there are things that mean that you can turn around and say, oh, actually, I am welcome here. I can stay. And by the way, you can get a golden visa in a week. I've made poor friends. I have a lot of friends that are trying to get H1Bs in the States, and it's a mess. For us here, you get it a week and you can stay. And that's, I think, things like that are really have actually succeeded in changing the narrative around, well, what is the long-term story here? And it's a very strong one. And so and for me, it's, the UAE is, I'm very comfortable in the UAE, especially. I think there's a lot happening in the rest of the region, but at least for right now, they very comfortable with the bet here.
Fantastic. Thank you, Adam. I think it's a really good place to kind of finish off the conversation. I've learnt a lot today. I don't know if everyone else.
Same. Taking lots of notes.
Yeah, we appreciate all your kind of insights, because I don't think we would have got that just from searching on the internet. So thank you. Please do tune in for the next episode for Those Made to Do. You can find us on YouTube and all the other channels for streaming. And we look forward to seeing you next time. Thank you.
Thanks for listening.
Thanks for tuning into the For Those Made to Do podcast. We are your hosts, Mandy Sahota
and Bianca Pavel. This podcast is all about the doers who have achieved career success in the UAE and the stories that go with it.